Hello everyone, and welcome to this presentation of the 5 best ways to invest $10,000. Now this is a timely presentation to be giving you because, well, first of all, we usually talk about trading with our free webinars, but we're going to alter things a bit and talk about investing because we're coming on to a new year, and I know a lot of people are interested in knowing how they're going to invest and put their hard-earned money into the markets or into some type of fund. Now the reason why we're doing this as well is because a few weeks ago in the Los Angeles Times, there was an actual article with this title in the Los Angeles business section of the 5 best ways to invest $10,000. And they went into detail, and we're going to go over that as well in this presentation. So welcome once again. This promises to be a great webinar for you. My name is Steven Primo. I am the president and founder of Specialist Trading. And if you're new to my webinars, you'll see that, especially in this webinar, we're all about teaching you and putting the power in your hands. I've been trading for nearly 4 decades, and if there's one thing I've learned is that the only way to become a consistent trader and or investor is to become a part of the process. In other words, you have to be in the decision-making process. You can't give your hard-earned money to someone in a chat room or a trade room or someone, a financial advisor. You have to be making the decisions on your part because that's really how you'll become in tune with your own trading and investments. And so I've started my career on the floor of the stock exchange. I was on the floor for a total of 16 years. 9 of those years I was a specialist, meaning that I made markets in roughly about 50 stocks. I traded through the crash of '87 and the bull market that followed, so I've seen just about every market environment imaginable. I know how to trade and how to invest your money in a consistent manner. So we're not trying to say here that we have the perfect system or the perfect trading technique that will generate thousands and thousands of % per year. We really don't believe in that. What we are trying to do is instill the things that I have found in my 4 decades of trading that have worked in terms of consistency. And once you've learned this and educated yourself with these techniques and methods, you can make your own decisions and thereby get onto that road to consistency. So that's our goal, is really to teach you, because we are an educational company first and foremost. Now I want to give you a great presentation today and fill your investment ideas with a couple of really nice techniques that you can start applying for the next year. But as always, before we begin, we are required to show you our disclaimer, so please take a moment to view it. I'm going to show you a lot of performance results with this particular technique, actually 2 techniques today, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated. So as I stated earlier, we're required to show you this, so as you are taking a brief moment to view our disclaimer, I would also like to take this time to invite you to follow us on Twitter as well. There's our handle right there. You may want to copy that. I post information on a daily basis, anywhere from little tidbits of wisdom in the financial markets to actual signals that our strategies have generated. In fact, just a couple of weeks ago, we generated a really nice buy signal in multiple strategies, and as you've seen, the market has gone straight up in the last couple of weeks. So there's a lot of great free information, although rather limited, but feel free to follow us on Twitter. Okay, as I stated just a few minutes ago, our goal is not to force feed you signals. It's not to force feed you the perfect time frame or the perfect market. Our goal is really to teach you so that you can put the power back in your hands. And we're changing things up a little bit today. As you see, my goal is to teach you how to trade. Well, today we're going to be talking about investing. So today my goal is to teach you how to invest with a specialist edge. Now, this is the same edge that turned my trading around, and I really believe has been able to sustain me going on 4 decades now. In just a couple of weeks, I will be trading nearly 40 years altogether. So these are the things that have sustained me, and I really think once you've learned this information through me as your personal mentor, you will be able to sustain your trading, hopefully for a good 30, 40, even 50 years. Now, one thing I do want to mention, since this is an educational webinar, I do like to take all of your questions, but just like a classroom, I would like to take them at the very end because I have a lot of great free information to share with you today. But if we stop at every slide for a question, we'll really slow down the process, and this will turn into not a 45-minute presentation, but a good 4-hour presentation. So if you have any questions, please wait till the very end. I will give you an email address as well at the very end if you'd like to ask a question, and we'll have a lot of great information for you. But either write down or remember your questions, and we'll answer them in just about a half an hour from now. Also, if I will answer the most popular question, and that is this being recorded? Yes, it is. So if you're having technical difficulties or if you have to leave early, all of our presentations actually are recorded. Pro Trader Strategies is my sister site. They handle all of my marketing and all of my webinars. You can contact them and they will send you a link to this recording. Okay? So once again, if you joined us late, just wait for the end of the presentation to ask any questions. Excuse me. So why don't we begin? Now, the reason why this presentation is titled The 5 Best Ways to Invest $10,000 is because, once again, this was the title of an article in the business section of the Los Angeles Times just a few weeks ago. It stated, your definition of a windfall may vary, but there's little argument that $10,000 is a healthy chunk of cash. I mean, certainly enough to give you cold feet when deciding how to invest it. But the good news is that there are a lot of options because the amount is more than enough to meet most online broker minimums. So we've slimmed things down to the 5 best ways to invest $10,000 in 2017. So once again, this is a LA Times business section article, and this is their insight and opinion on what the 5 best ways would be if you had an extra $10,000. I'm sure many of you may already have that, and if you're wondering about how to invest it. And here are their 5 points. All right. The first one is to get your 401k match. In other words, if you work for a company, an institution that allows you to match what you're putting in, this is a good way to build and grow on a steady, consistent basis your 401k. Another way to do that is to max out your IRA, okay? In other words, there is a max amount that you can put in. Don't quote me on this because I'm not a financial broker, but I believe it's $6,000. I'm not sure. You'd have to check with your accountant, but max it out. Whatever is the max you can put in on a yearly basis, max it out, because that's the way you will be able to grow your investment account rather, in one large big sum. And then probably the most popular way is to get a financial advisor, okay? Now we've labeled these all in white or colored them all in white. As we go into the next one, we've colored it back in yellow again because 4 and 5 are very, very attuned to what we do. 4 says to invest in ETFs and 5 says to invest in stocks. Now, as you see there, why did we color some in white and color some in yellow? Well, the reason is because the first 3 basically have something very similar in common, and that is what I spoke about earlier. They are great ways to invest the money, but basically they're all the same in that you are totally out of the picture. You're not involved at all. In other words, you're giving your money either to a financial advisor or you're putting it into your account and you're basically saying, gosh, good luck. I hope you do well with it. And there's no guarantee that any of that will work. I mean, you could max out your account. So what? It means you could maybe lose it all the next year if you have a terrible idea of what you're doing. Or there's no guarantee that a financial advisor will be able to grow your account the way you want it to. So what you're doing is basically, if you look at your hard-earned cash and money as your child, as your children, you're basically giving them to someone else to raise. You're saying, I'm not a part of the raising process of my children. I'll let you raise them for me, okay? You've taken yourself out of the game. Here's where we come in. We believe that 4 and 5 are actually your best bet for increasing your consistency with your investments and for investing the $10,000. And that is to invest in ETFs or invest in stocks. And it's not so much that ETFs and stocks are the best ways to go. It's that you are a part of the process. When you're investing, you are a part of making your own decisions, okay? You've put yourself in the game. Rather than giving your children to someone else to raise, you're taking care of them. You're raising them. You're disciplining them. It's the same way with your hard-earned money. The trouble is, I would say a good 3/4 to 90% of most people have no idea, myself included when I first started, how to invest at all, okay? No one has any clear idea because investing is something longer term. Most people think, well, in order to invest, I have to have gone to school, right? I have to have a degree in business or at least taken some courses on what to do. I have to know about companies. I have to know about what's going on economically or all the news that's coming out, interest rates cuts, things that are going to be announced later today, or I have to know about them, what that means and how to decipher it. Okay, this is why most people stay out of the game. It's too confusing. It's very intimidating. And it's scary. Let's say, it's your money and you don't know what to do with it, all right? The good news is that's what we're here for. This is what we do. We teach you how to put the power back in your hands so you can make your own decisions. We give you sound ideas and methods that have stood the test of time. So we really think that, sure, these are all great ways to invest, but 4 and 5, in our opinion, are the best. And here's where we can help you with them, okay? Now, when we're talking about investing, there are 2 types of investing. Remember, investing is longer term. Usually you'll see me in these presentations on a weekly basis. I'm talking about trading, anywhere from weekly to actual intraday bars, tick bars. We're going to talk about something that's a little longer term. We're talking about looking at monthly bars instead of daily bars or even 5-minute bars. We're talking about the long term because if you're investing, you're holding anything from either 1 to 3 or 5 years or from 3 to 10 or 20 years. Now, the 2 types that we're interested in and that we really feel we can help are, 1, continuation type investing. All right? What does this mean? Well, this means that you're looking for some type of trend to be established, and you're not looking for to catch the bottom or to get out at the top. You're just looking for the trend to be established, and then you jump on board. And then the other type, which is a little bit more hands-on and closer to trading, is pullback investing. And that's where you're looking for some issue or some equity or some ETF or some fund that has really fallen out of bed. It's still in an overall uptrend, and you're looking to pick a bottom within that pullback area, okay? And when we're talking about investing, I would say the majority of people are investing for the long term, and they're holding on to issues or ETFs or stocks, and they're holding on to them in a long manner. And in fact, they're investing in them. They're not shorting. So we're not going to be talking about shorting today. We're talking about the classical way of investing. Now, if you want to see what this looks like on a generic chart here, when we're investing, either way, we're looking to buy or to purchase something. And it's for a long-term uptrend, okay, as we see here with the upward sloping green arrow. Now, this is what we're looking for. If we are a continuation type of investor, we're usually holding things a little bit longer, anywhere from 3 to 5, possibly even 10 years. And remember, once again, as a continuation investor, you realize that markets, while they're still in an overall uptrend, will fall, and they'll go into this downward period. We're still in an overall uptrend, and once we start to see that that trend is starting to go higher, it's starting to continuing back up, that's when we jump on board. So we're not looking to catch any bottoms or get out of the tops. We're looking to just make sure that we're starting to go back up again, and that's when we get in, okay? That's a continuation type of trading. If we're a pullback investor, well, we're a little bit more hands-on. We're not holding things as long, maybe 1 to 3 to 5 years, but we, once again, are realizing that since we are pullback investors, we know that markets in an overall uptrend will start to head down lower. This is where everyone gets out and gets scared that we're going into a bear market. As a pullback investor, you are looking for the bottoms in those downward moves, and you're trying to buy at the bottom in the hopes that you will turn around and go back up, okay? So once again, continuation traders are looking for a continuation of trend to jump on board. Pullback traders are looking for some type of bottom. Now, we're going to start by looking at ETFs. And ETFs, in our opinion, are more conducive for continuation investments. You're going to be holding on to them longer, okay? We're not looking to trade or pick bottoms in ETFs. We are looking for these nice trends, either to get in or get out and then get back in again, but for the long term, okay? Remember, investment means a longer term, so we're not going to be looking at daily or weekly bars. We're looking at monthly bars. Now, we're also going to be looking at 4 of the most popular ETFs by trading volume, just to give you some idea, okay? So let's start out with GLD. Now, this is the Gold Shares ETF, which represents gold. We're looking back to 2009, roughly about 6 or 7 years ago, okay? As we can see, we started out in 2009 with a real nice upward run. This is where you would have jumped on board to go long to buy in this investment of gold if you wanted to go long gold, all right? But then we kind of topped out, and it would have been time to get out of gold. Now it looks like it's still up in the air, but it looks like we've started to continue going up. So we want to find out if we should be buying gold or not on a monthly basis. Remember, these are investments. We're not trading. But starting in 2016, this past year, gold started to move back upward. So is this a move upward, a continuation of an upward trend, or is this just a bounce before we head much lower? All right, USO. Now this is the ETF that represents oil. This is the United States Oil Fund. As you can see, this is going back to 2014, just about 2 or 3 years ago. Oil was going slowly upwards, but then starting in mid-2014, we really started to head lower. So we would have wanted to be out of oil in this move. As a continuation trader, we would have wanted to have some type of signal, not at the very top, but something to tell us to get out of oil and not be in oil, because it hasn't looked as if it started to go back up yet on a monthly basis, all right, according to this ETF. How about bonds? Okay, this is JNK. This is Barclays High Yield Bond ETF. Now, as we can see here, it looks similar to bonds, but I should say oil, and we were going slightly higher, and then we made a real strong move starting in 2014 all the way down to the beginning of this year. But since the beginning of this year, well, JNK, or the High Yield Bond Fund, has started to go back higher. So this ETF has looked like it has continued in its upward course. And now we're looking at the granddaddy of all ETFs. That's the SPDRs, SPY. This is the ETF that represents the S&P 500 index. Now this is going back a little bit further. This is going back a good 12 years or so, 12 or 13 years. As we see back in 2003, we had a really nice run-up until 2007, where we topped out, and then in 2008, we all remember the banking and financial crisis, okay? That's where the last big recession started, and the market really fell out of bed. Now, coming into 2010, it looked as if we were continuing our upward course, so you could have gotten back into the market, and the market, as represented by the SPDRs and the S&P 500 ETF, has continued to go higher and higher. So this, just looking off just off a first glance, these are what ETFs look like for investing. You see these nice upward moves followed by these downward swings and then an upward continuation. So as a continuation trader, we want to, once again, get in once we see that the upward trend has started to go again, and that's where we want to continue our investment. Here's the only trouble. How do we know when to enter and do a continuation investment? How do you know if you're just going to enter and then it's going to turn around? Because it is difficult. You know, sometimes you'll see a nice bounce for 2 or 3 months. You think, well, now we're going to go back up again. All right, that long dry period to the downside is over. So now it's time to get in. And then it goes right back down again. So how can we have some type of certainty in terms of consistency to know when to enter into a continuation investment? Here's how we can help you. This is probably the best tool I know for trading in terms of trends. You've heard me speak about it before, but up until now, we've only really discussed in detail how to apply it with intraday and daily bar trading. Now we're going to show you how to apply this with long-term investments, in this case, continuation investments. That's by simply applying the PET-D. This tool is so versatile. It's something I was introduced to nearly 40 years ago on the floor. And it's a proprietary color bar algorithm. So all you have to do is follow the colors of the bars. It's that simple. There's really no work, because what the PET-D does, it's not an indicator. It does not in any way try to pinpoint or tell you how high something's going to go or how low. It's not a predictive tool. All it is a translator. And it just simply translates whatever market you're looking at in whatever time frame wants to do at that current moment. So it's in no way indicating which direction something's going to go. It's no way indicating how far it will go. It's just simply telling you that the market at this time wants to do this. And when the market tells me it wants to do something else, that's when I'll change color. So if the market wants to go up, it's going to color the bars green. If the market changes its mind and wants to go lower, it's going to color it red. So this gives us a great way in which to know when the continuation has begun to the upside. So let's go back and look at GLD. That's the gold ETF, all right? Well, we wanted to be invested in long gold shares in this ETF when we were going up from 2009 all the way to 2012. But then we wanted to be out from 2013 down to 2016. And then possibly get back in. How could the PET-D have helped us? Well, we apply the color bar tool, and we can see as far back as the beginning of 2009, the bars were already green. Now, here's the way we're going to use it for long-term investment. This is called the rule of three. It's not really a rule, but it's a suggestion, something we found over time, that for long-term application of the PET-D, when you see three bars that are colored the same color, either three consecutive green bars or three consecutive red bars, that's telling you the continuation of the trend. So obviously, if you see three green bars in a row, you want to be in whatever ETF or investment that is. And obviously, if you see three red bars, as we saw right here, you want to be out and you want to exit. So you could have been in gold from 2009 all the way back here at 80, ridden it all the way up here. And remember, we teach you different exit plans in the course, but if you just wanted to use the PET-D as your tool for entering and exiting, you could have exited at these levels, okay? From roughly 80 all the way to 145, 150. So that's nearly 60, 70 points in the next 3 years. You would have missed gold's downslide this entire time. You would have been out of the market. Your money would have been in cash or in another ETF, and you wouldn't have had it tied up here, giving back all of your gains, which is the way most investors trade. They hold on to it. How many people have been taught to buy and hold? Well, had you purchased somewhere around here and then held it here, guess what? You have nothing to show for your 5-6 year investment, okay, in this ETF. But if you had the PET-D, well, you'd be long roughly here and then out roughly at this point. So at least you would have made a good maybe 50 points or so. And you would have had the satisfaction of knowing that you're not in gold this entire time it's going lower. Now, what happened here in the first 3 months of 2016? Well, we had a series of 3 consecutive green bars. So according to the PET-D, you should actually be long gold at this time, even though we are lower than where we entered on this one red bar. Who's to say that it's not similar to this, and then we're going to go right back up? Until we get 3 red bars, we are still long gold, according to this ETF, GLD, okay? So you see how simple this is and how you are a part of the process. You're making your own decisions. You're not sitting here while you're seeing your gold profit go all the way lower and lower and just come down to basically breaking even and having some financial advisor say, well, you know what? I guess we didn't do well. At least we can get out at even or maybe make a few bucks. Why don't we exit right here well before it starts to go back up again? Here you're making your own decisions. All right, let's look at the next ETF. This was USO. That's the United States Oil Fund ETF. And once again, we were seeing oil, this was back in 2014, a couple of years ago, have a nice steady upward move, and then it just literally fell out of bed. What if you were invested in oil and, like most people, continue just to buy and hold? And what the big trouble is, what a lot of people do is as it goes lower, they say, well, it was a good investment before, so I guess I'll buy more. And you just keep buying and you're seeing your hard-earned money just whittle down to nothing. Let's add the PET-D and see how it could have helped with this particular ETF, all right? As we see, you would have been long USO or the oil fund ETF coming into mid-2014. And what happened right here? 3 consecutive red bars. So depending on where you got in, you either took a small loss or you maybe got out with a small profit, but either way, you would have exited oil in July or August of 2014. That's over 2 years ago. We're almost going on 3 years ago. You would not be long oil as an investment. And don't you think this could have helped you stay out? Even though oil is at its nice fits and starts, if you were in this ETF, all right, don't you think you would have liked to have been out? Now, what we're waiting for are 3 consecutive green bars, monthly bars of this ETF or any other oil ETF to turn green, and that's when we'll get back in. But right now, your money isn't tied up. You're not in a losing position that just keeps dwindling, and every time you look at your monthly statement, you're thinking, oh my goodness, this is just terrible. When's this thing going to turn around? You're out of this completely. Why? Because the translator translated that this is now in a long-term downtrend. You don't want to be in anything in a long-term downtrend if you're investing. Okay, let's go to the next ETF. This is JNK. This is the bond ETF. As you can see here, going back to 2013, it was steadily headed higher. Then all of a sudden, bonds fell out of bed, and they started to firm up in the first quarter of this year, and they've continued to go up. How could we have gotten in when we were long, waited on the sidelines when we went lower, and then got back in as a continuation trade? Well, we applied the PET-D. And even though the Pet D did not get us out at the top, it's not designed to do that. It got us out well before this sustained 2-year sell-off happened in bonds. So you would have exited up here, according to this ETF, roughly around 40, and the ETF went and lost nearly 10 points, about 8 points in the next couple of years. Coming into the summer of this past year, July, we had 3 consecutive green bars. So you're back in. You just saved all of this time and money, having your money tied up, holding on to a loss, and just the emotional problem of having to hold on to this, the emotional intensity of having to hold on to a losing position. You weren't in this at all. You could have had your money on the sidelines. You could have had it in another ETF that was winning, that was going up with green bars. And if it were, you had more cash, you could have entered back into the bonds roughly about July of this past year, where you would still be long coming into 2017. Lastly, let's look at the spiders, okay? We've had some big swings. This is going back once again about 12, 13 years. How could the Pet D have helped us take advantage with the ETF that mirrors the S&P 500, the spiders, okay? Well, let's simply add the color bar tool. And once again, we see coming into 2004, we were long the market the entire time, all the way. Now remember that Pet D does not tell us how high something's going to go or how low it's going to go. It's just simply translating what the market is doing at that time. The trouble is most people never listen to the markets. What they're listening to is some financial advisor, some economic indicator. They're listening to some fundamental news or earnings, and that is usually very late or it's too difficult to discern. It's too discretionary. What we want to do is just listen to the source. And what's the source? The market we're investing in. Excuse me. So we are long the market in this particular ETF, according to the Pet D, right here until we had 3 consecutive red bars. Okay, we have 4 circled, but we're only looking for 3. Now, this was well before the debacle happened in the market. This was back in 2007. The real damage started in 2008. That's where the recession started. That's where people started getting laid off. That's where people lost their houses. Well, you're out of the market if you're in the spiders well before that. You would have exited, missed this entire crash that happened going into 2009, 2010. Okay, so you have your money in cash. Most people continue to hold on. How many people did you know, perhaps yourself, that continued to hold on to your investments and saw them dwindle down to nearly nothing? And so many people, it's so sad that most people got out and sold everything, and whatever money they had left got out right around here, right around the time, a year or so earlier, or later I should say, where there were 3 consecutive green bars. Had you been on the sidelines, you would have been able to get back in right here. This was in 2009. Okay, where most people were still saying, no, this is just a bounce. We're going to head much, much lower. Remember, we're not listening to outside sources. We're only listening to the source, which is the market or the ETF you're currently trading. So you would have re-entered back into the markets at this time, and you would continue to be long because, as we've seen, we continue to go higher. Sure, we've had series of a couple of red bars now and then, but remember, the rule of thumb is we're looking for 3 consecutive bars of the same color. We have not had any 3 consecutive red bars since 2009. So wouldn't you like to know when we have 3 consecutive red bars in the market, in the spiders, in the index? All right, so that, in my opinion, is the best way to put the power back in your hands for continuation trading. This is where you're looking to hold things, as we stated here, and as you can see, for a good 3 to 5, possibly 10 years, holding things for those long sustained trends. Remember, we're not trying to get in at the bottom. We're not trying to get out at the top. We're just trying to take a big chunk of that nice trend, a continuation of the trend, all right? That's more of a long-term investment. If we want to put things more in our hands, if we want to be a little bit more hands-on with our investment, if we want to be in something from anywhere from 1 to 3, possibly 5 years, well, then we trade stocks, and stocks are more conducive for trading with pullbacks. So those are more for pullback investments, okay? So let's look at some very popular stocks that have been in the news, stocks that have a lot of volume. Let's start off with SIRI, Sirius Satellite. As we can see here, in 2008, the stock really fell out of bed, but starting in 2009 and 10, it started to have a nice sustained upward trend coming into this past month. By the way, these charts are all currently from going into this past months or so. Now, if you're a pullback trader, remember, we're not trying to look for any type of continuation and then saying we're just going to stay in long. What we're looking for is sell-offs in this upward trend. Once we know that we have a nice sustained overall upward trend, we're looking for the sell-off, such as right here, and to buy on the bottoms, all right? We want to see another sell-off, we want to buy there, and then the markets will go up. And then we want to see another sell-off, we're going to purchase some more shares here. And as we go up, more sell-off, and so on. So we're kind of, in a sense, trading, but since we're looking at monthly bars, you could be holding a position such as right here, these two positions, and then getting out maybe a couple of years later, getting back in, getting out again, getting back in, and getting out again. Okay, this is a very inexpensive stock. This is only a $4 or $5 stock, but you can do this as well with inexpensive stock, or you can do it with an expensive stock. Here's Apple. Okay, now as we can see, obviously we've been in a sustained overall uptrend. If we are a pullback trader, rather than just hold on, what we're looking for is to buy on these sell-offs and to try and pick a bottom to buy somewhere here, and then wait for the trend to go back up, and then see that we have another sell-off, and then buy somewhere around here and hope that the trend goes back higher, okay? Facebook. Now, this is a very interesting scenario here because we're going back to when the company began first here in 2013, 2012, 2013, and we've been in a overall sustained upward move, slowly upward in the beginning, but then sustained. But there's really been no pullback. I'm going to show you how you can possibly take advantage of this in just a few minutes. And then lastly, Netflix. Okay, great stock. A lot of people have been looking at this. Now, we were in a sustained uptrend starting here, according just to what we're looking at right now. In 2013, we started going higher, but could we have taken advantage of possibly buying here on this pullback? And then as the trend went up, we have a couple of more pullbacks here, and then we go higher, and we have a sell-off and a pullback here. So as you can see, that's the way stocks trade. As I've said before, ETFs are great for continuation, holding on for those long sustained trends. Stocks are a little bit different. Stocks have these nice trends, but then they pull back. And then they give you a chance to get back in, and then they continue their upward movements. Okay, so you're not in them as long, and you don't have to use that sustained technique of holding something for until you see three different bars. We want to use an entirely different approach. Here is the only problem, once again, because you have to ask yourself, how do we know when to enter into a pullback investment? Because you could say, well, we've pulled back enough. Okay, Steve, I went to this seminar, and this guy says that we have to look at the Fibonacci levels. That's what tells us when the pullback's over. Or another one will say, no, you have to look at the volume and what the institutions are doing, because the institutions are the smart money. Okay, they know when a stock's going to stop going down on a long-term basis, and they're going to start buying. Okay, or no, even more, better still, you have to look at the earnings. Okay, the earnings define when a stock is going to start moving back up. Okay, trust me, I was trading on the floor of the exchange. I knew about all these things. I followed them for a good 2 years, and guess what? I didn't make a dime. I followed Fibonacci support, resistance levels. I followed all the institutions. I followed earnings because I was in charge of making markets in 50 stocks. All right, you would think someone in my environment with all that knowledge of all these different companies and access to that would have had a better edge in being able to apply them. And they didn't make me any more money than someone just throwing darts at a dartboard. So there is really no consistency in those methods because they're very subjective. It's very subjective to try and figure out what someone or a company's earnings are going to be, all right? And then even when they come out, you can say, boy, those are great earnings, and how many times have you seen that? And the stock goes straight down. Or how about the institutions? The institutions, if you look at their track records, have terrible track records, okay? They don't really perform all that well, so why would you follow them? Why would you believe that they know what they're doing? And trust me, trying to figure out, different levels of volume or economic conditions, it's very difficult to do. Wouldn't it be better just to simply listen to the market you're trading and have it tell you what it's going to do? Isn't that a little bit more logical rather than listening to all these outside sources where they think they know what's going to happen? I would rather just listen to the market. And it wasn't until my mentors taught me how to do that that I was able to sustain my trading for going on 4 decades now. So when we ask ourselves, how do we know when we're going to enter into a pullback? We don't look at all the conventional traditional wisdom. What we do is, once again, we apply the PET D, because the PET D is telling us what the market wants to do. So here's the investment entry technique we have for long-term investing. In an overall uptrend, and you notice here I put in quotations uptrend because I'm going to share with you our best source of defining what an overall uptrend is. You're going to see a small amount of red bars, okay? They're going to appear. This is the pullback. So now we know when a pullback is in place. All right, we have an overall uptrend, and these red bars are not telling us that, oh, I guess we're in now we're in a bear market. No, we're just in a pullback. Now the very next green bar that occurs, is our confirmation that the pullback has concluded, and that's your entry. It's that easy. There's no reason to try and look at what the institutions are doing. There's no reason to look at volume. There's no reason to look at Elliott Wave. I mean, it's too discretionary. Just look at what the market is telling you, okay? So let's go back and look at these stocks, okay? Sirius Satellite Company. Now, someone looking at this saying, but whoa, way back in 2008, we really fell out of bed here. How could I avoided all of this and then known when the uptrend had started? You know, for all I knew that this was just a little snapback before we went lower. The easiest and most powerful way, you've heard about me talk about it before, to find out what the overall trend is to apply a 50-period moving average. And if the issue, whatever you're looking at, is below, the overall trend is down. And once we are above, and we have consecutive closes above, then the overall trend is up. And that's all you need to know to find out what the overall trend is. Now, how do we enter on a pullback? Remember, we're only going to be buying because we're investing. We're not trading. Traders like to buy and sell, go long, go short. As an investor, especially beginning investors, we have a lot of people that are new to investing here in this presentation. We're only going to be talking about investing on the long side. We're not going to be talking about shorting anything. So we're only interested in looking at overall long market setups, okay? So we're looking at going long. And so at this point right here in 2011, the 50-period simple moving average told us we are now in an overall uptrend. So now it's time to look for pullbacks. How do we do that? We add the PET D, all right? The bars change. And we see, even though the PET D was signaling that we were now going higher back a year earlier or 2 years earlier, that's okay. We are pullback traders. We're not looking at continuation trade. Here's our first red bar. So that's telling us what? We're starting a new bear market, that we should get out? No, it's just telling us that that's the pullback since we are still above the 50. And here's the first green bar. So what is that telling us? It's telling us that's our entry. So we buy right here, and you could have purchased it roughly at 1 3/4, 1.75, okay? And the stock went up. Now we have another couple of red bars and another green bar. If you wanted to purchase more shares, you could have bought some more at roughly 2 1/4, 2 1/4. And now look what happens. We go straight up to 4. Okay, you just about doubled your money on your investment. Now, we're not saying you would have held it all the way here, but look how much you had to work with. Remember, we want to put the power back in your hands. We don't want you relying on someone telling you what to do or how to do it, what market you should be in. I mean, how many people do that on a consistent basis, and how many people do you hear complaining about their investments? Just about, the majority of them. So these people, or different ways in which to invest your money, have no better track record than you just throwing a dart. So why not just take charge of your money? Remember, I use that analogy about children again. Would you rather have someone raise your children, or would you rather do it? It's the same way with your hard-earned money. You should be raising your children. You should be making your decisions. So with the PET D, it's easy. If you want to be a pullback investor, you had all this room to work with. Now, what most people do if they're pullback investing is they'll sell a portion of their shares. They say, I made a nice investment. Maybe I doubled my money, or I made 50%, and you exit at least a portion of your shares, okay? Now, when we get the next pullback, 3 red bars here, remember, we're not continuation trading. We're only pullback trading. Now we enter to go long again, and we're long now at 3.5 roughly. The stock goes up to over 4. Another pullback here, another buy. We buy at 4, and currently the stock is close to 5 now. So you're still doing well, just using this simple pullback technique. We're not a continuation trader. We are only looking for pullbacks. Let's look at Apple, okay? This is going back to 2009, roughly 8 years or so. As we can see, obviously, in hindsight, we're in an overall uptrend. It's easy to see anything in hindsight. Anyone can do that. But wouldn't you have liked to have known back here that you were in an uptrend, okay? Well, let's apply the 50-period moving average. And even though we had 2 or 3 closes below, the majority of bars were closing above. And if we apply the PET D, guess what? Our first green bar that closed off of the initial red bars was above the 50. So that's our first buy-in. And where could you have purchased this? Well, this would have roughly been about $20. We know it's split so many times, but just on a cost basis, we're buying roughly at $20 right here. And this is back in 2009. So whatever the price was before the splits, you could have purchased Apple going back roughly 7 years ago. Wouldn't you have liked to have known that just by simply using this PET D? And someone could say, well, wow, you must have a great financial advisor. They must have told you about this company well before anybody else. No, I did it myself. My own investment and my own research, which took me maybe about 15 minutes to figure out, okay? And they say, well, what did you do? Do you have some special system, special indicator, or some special strategy that has tons of rules? No, I applied the 50-period moving average, and the very first green bar after the pullback is my entry point. So I've been long since 20, and that's it, okay? Trading is simple. It's just us that make it more difficult than it has to be. For some reason, we've always been taught that the more complicated your trading or investment plan is, the more profitable it will be. And it's, in my 4 decades of trading, it's the exact opposite. It's the simpler your investment plan are, the more profitable it will be. So starting in 2009, Apple on a cost basis went up from 20 all the way up to 100, okay? Roughly 400% you made there. All right, now we're not saying you held it that entire time. Sure, a lot of people did. A lot of people just hold on to Apple and forget about it. But you know, how many people bought it back at 20? So many people will buy it here. They'll see the pullback in phase. They get scared. They think it's the beginning of a bear market and we're going all the way back down. So they sell. And in all actuality, this is just a pullback again. You should be looking to buy here and here and here. That's roughly about 80. Had you sold a portion of your shares anywhere around here, you could have got back in and the stock goes back up to 130. So there's another 50 points in your favor. Starting in July of 2013, you could have been long again. Now, anywhere you could have sold a portion of your shares, you wait for another pullback, you would have entered again here at 120. This so far hasn't reaped any real nice profits. We went lower, but there's more pullback buying here at roughly 110. And we've continued to hold long. So on a long-term basis, regardless of what the daily or weekly bars are doing, on a long-term investment basis, you should still be long Apple if you're an investor. All right, how about Facebook? Now remember I told you about this. This is a little bit different scenario because we really don't have any pullbacks here. In fact, if we add the 50-period moving average, we see that since the formation of the company, we don't really have enough bars to go back to tell us that we were in an overall uptrend until going back to roughly July of this year, looking at monthly bars, okay? So we didn't really know till May, June, July that we were in an overall uptrend according to the 50 period. But that's okay because once we add the PET D, we've been green this entire time. And guess what? We are currently in a pullback phase of Facebook. So wouldn't you like to know when the next green bar is going to occur? Because that's going to tell you when to enter Facebook, okay? Just want to give you a little tease here that Facebook on an investment environment per se is in a pullback right now. It's not in any, large sell-off. If someone says you should get out of these shares, no, we're just in a pullback phase right now. But you will not enter until the first green bar. So this is something to watch if you are a PET D course member. And then Netflix, okay? As we've seen, this stock is great. I mean, this stock had a real big run up going down from 2009 all the way up to 2011, and then we sold all the way back down. And since 2013 have gone straight up, okay? But we've had some nice fits and starts. How could we have taken advantage of that? Well, the first thing we want to do is add the 50-period moving average if we're a pullback investor. And we can see that going all the way back to July of 2010, we have been above the 50. So this entire time, we're in an uptrend. And now we want to add the Pet D to tell us where the pullbacks are. We add the Pet D, and here is the first pullback in 2011 coming into 2012. So this entire time, if you're interested in this stock, Netflix, you would have done nothing until August, September of 2012, where the first green bar was, and you could have purchased Netflix roughly about 4 years ago at about $12, okay? Based off the earnings, based off what the institutions were doing, based off the volume, based off Elliott Wave or Fibonacci? No, based off what the market is telling you it wants to do. The market is telling you it wants to go higher. So there's no discretion. There's no, kind of thought process thinking like, well, what do I do? I mean, does this mean that it's a support? It looks kind of like a resistance to me. The trader I know says this is resistance, but it looks like support to me. So there's no discretion. There's no subjectivity. It's cut and dry. It's the first green bar. So you could have gone long Netflix roughly 4 years ago at 12. Now the stock quickly in the next 2 years goes all the way up to 60. All right. So you got a nice 50 profit move there. If you wanted to, you could have exited some of your shares along the way. And on the first red bar again, here's another pullback and another pullback on these 3 red bars. Chances to get back in at 65, and stock goes up, and you could have doubled your money because we went up to 130 at the beginning of this year. I'm sure if you're a pullback trader, you would have liked to exit some of your shares along the way. And if you've got some more cash, 3 consecutive pullbacks were here at the summer of this past year, telling you to get long Netflix roughly around the par area or 100. And you've gone up roughly 30 points since then. You see how simple this is. Trading is really simple. It's just us that make it more difficult than it has to be. There's no reason you have to go to business school. I didn't. There's no reason you have to look over pages of material of economic news and earnings and forecasts. It's silly. That there's no guarantee that that's going to get you in tune with what the stock or the company or the ETF wants to do. There's no reason you have to take these courses and spend tens and twenties of thousands of dollars throwing your money away on things that you don't even understand. I've been there. I know. I did that 40 years ago, and it didn't help me. The only thing you need to do is listen to the market. I didn't learn how to listen to the market until my mentor showed me. And it has really changed everything for me. It's the reason why I'm still here, while I'm still trading, while I'm still investing 40 years from now. So let's review before we go into your questions, okay? Remember, the best way to invest $10,000 for 2017, in our opinion, it's by becoming a part of the process. Whatever you want to invest in ETFs, if you want to invest in stocks, if you want to invest in funds, whatever you want, you need to become a part of the process. It is our strong belief that once you give your power away, it's a recipe for a disaster. That's when you've really taken away all of your input. You've given it to someone else. And there's no more guarantee that that's going to be successful than anything else. So why wouldn't you want to raise your children, your hard-earned cash, okay? Become a part of the process, and we really strongly feel that you will be on that road to consistency in terms of your investments. Remember, there are 2 types of investing in our opinion. There's continuation investing, which is basically a longer-term approach. You're looking for a nice upward trend to be established, and then you jump on board. Or there's pullback investing. That's a little shorter time frame, anywhere from 1 to 3 to 5 years. You're waiting for the pullbacks to occur in an overall uptrend, and then you're trying to get in at the bottom when the first green bar appears, the very beginning of the trend, okay? They're both valid. There's nothing wrong with either one of them. It's just people are different. Some people like to just hold on, and then you're a continuation investor. Some people like to be involved in the process a little bit more. They don't want to be tying their money up for 5, 10, 20 years. Well, then you should become a pullback investor. The good news is we can show you how to do both. The 5 best ways to invest according to this LA Times. Remember, the first 3 are great, but the first 3 have no input on your part. If you want to have input, if you can still match your 401k, you can still max out your IRA. You just don't need a financial advisor. If you do have a financial advisor, you can use them sparingly, okay? Because you're in charge of your investments with ETFs. You're in charge with investments with stocks. Now, As we close here, ask yourself and ask yourself honestly, do you think these edges could have helped your investing and can help your investing this next year in 2017? I mean, we only have a couple more weeks before we begin a new year. And I know everyone, virtually everyone out there is probably saying, boy, I started 2016 with all these goals and all these hopes and aspirations, and I'm nowhere near where I want it to be. In fact, 2016 may have even been a losing year for you. Everyone starts the beginning of the year with all these great, great goals, and I can venture to say that the majority of them are never met. Why? Because you're building your house on, on faulty format, or building your investment house, I should say. It's not, it's not that it's wrong. It's just that you can't sustain it. There's no consistency in these methods. I know some traders who do well trading Fibonacci, who do well trading support and resistance, who do well following the institutions, but they're probably the 1 to 5% of all traders. The majority of traders, myself included, the 95 percentile, have a very difficult time trading or investing that way. Isn't it much easier if you learn how to invest simply and concisely and with consistency? Well, that's what we do at Specialist Trading. Now, here's our special discount for today to get you on track for 2017. We're going to offer you the PET D, all right? This is the Primo Early Trend Detector. It is basically a roadmap for any market. This is the color bar algorithm, and you can apply an add-on to your current charting software, okay? We give you the add-on along with 2 continuation trading techniques, 2 pullback trading techniques, a trailing stop technique. And remember, you can apply this to any market, any strategy, and any time frame. A lot of people say, well, Steve, I don't need to worry about my investments. They're sound. I'm in other markets. I'm in mostly real estate, or I do other things. How about if I want to trade with these? Well, sure, you can. Let me show you some other time frames and markets where you can apply the PET D. Here's a daily chart of the INX, or the S&P 500 index. Now, say you wanted to just use this as a trend directional tool for the markets, okay? Well, you wanted to know when you should be trading the S&P 500. Well, once again, we see here that we have 3 green bars. If you're using the continuation technique, you could have used that as your green light to say, now it's time to be long the markets, and I can start buying the individual stocks I'm interested in. Because look what happened. The S&P index went up another 150 points after that, and that represented over 1,000 points in the Dow, okay? Now, a lot of our members are currency pair traders. So if you're a currency pair trader, you can apply this just as well for a long-term currency pair trading. You can apply the same technique we talked about. Here's a monthly chart of the British pound going back roughly about 3 years. Now, as you can see, all the bars were green on the British pound until right here. This was at the end of 2014, just a couple of years ago. If you were long the British pound on an investment type of basis, this would have been your signal to exit. Now, we don't know if you would have had a loss depending on where you got in, but the point is, this is where you want to be out. Why? Because if you exited here, you would have missed this entire sell-off coming into this past month in the British pound, okay? On a long-term basis, the British pound has continued to go lower. Now, a lot of people this past year were so surprised at the Brexit vote. They were so surprised that the market, or the vote was that way and the markets fell out of bed. Well, the PET D wasn't surprised. Remember, the PET D is just a translator translating what the market wants to do. And the market tells you what it wants to do, not some vote in Europe, not what happens in a political sense here in the United States. The markets tell you what they want to do. This is where you should be getting all your information, because here's where Brexit was, right there, all right? You were already out of the British pound. You already knew that it was in a long-term downtrend. So while so many people were complaining, currency pair traders or market traders, about the markets just falling out of bed off of this vote, the market had already told you 2 years in advance it's going lower. Remember, listen to the market. It tells you everything you need to know. You don't have to depend on some convoluted logic, some trading technique or system that promises the Holy Grail. The market knows what it wants to do. We just have to listen to it. So we're offering you the PET D with all of these different trading techniques, along with the add-on that will change the colors on your screen. This is basically a roadmap. So you'll have a roadmap now for 2017. Remember, we talked about investment today, but you can apply it for intraday trading. We show you how to do that in the course. You can also apply it any market, any time frame. You see how valuable this is, how you really helped you not just with hundreds of dollars, but with hundreds of thousands of dollars, how it can be saved or even made if you use it properly. Well, we're offering it for a discount at $29.95, but the great thing about this is that we're also offering payment plans. So we realize if you can't come up with that lump sum, you can put down a small deposit and you can be up and running ASAP. So here's how to take advantage of this great offer. You can be perfectly in tune with whatever market you're trading, either investing or trading for 2017. Contact Pro Trader Strategies. They are my sister site. Once again, they market and promote all of my courses. If you're interested in putting a payment plan, which I strongly suggest, that way you don't really have to come up with all the lump sum in one payment. You can simply call them up, and they, for a small deposit, will have you up and running right away. Okay. You could either email them, or the best thing would be to call them directly at area code 310-598-6677. Now, the link at the very bottom is a link that we have that will have this offer, but it's also with a strategy. I think if you just want to get the Pet D, if you look over on the chat box on the far right, that's the link you should click on because that's live as well. So go to your chat box on the far right-hand corner, and they've posted a link up there for the discount and for the package for the Pet D, okay? And it'll take you right there with more information. But I strongly urge you to either contact Pro Trader Strategies or take advantage of this right away, because in a couple of weeks we're going right back up to our standard price with no payment plans at all, and it'll cost you more, and you'll be that much behind the game. Okay, now I'm going to leave this slide up here so you can copy down all the information. Remember, use the link in the chat box on the far right to get more information about the current special we have. But I'm going to open up the question and answer box, and thank you so much for delaying any questions you may have. JC asks, can we see live charts? I'm sorry, JC, this is a static PowerPoint presentation because we give all our presentations, because we're an educational company. We like to, show you what we want you to learn. And a lot of times if we just have live charts, it won't show you what you need to learn in a specific example of a continuation or a pullback. So we aren't able to use or access any live charts, okay? I'm sure if you contact Pro Trader Strategies and request one, they will be able to furnish you with whatever you're asking about, though, okay? Let's see, also asking about scans. Yeah, you can get scans. Remember, you're not gonna, if you're asking about alerts, there's no really reason to get an alert with a Pet D because the bars are either green or red. And we don't want to turn this into a trading system. It's not a system where it alerts you to buy or sell. We want you to be a part of the process, but it's very simple. If you're watching daily or monthly bars, when the bars close, you know exactly what color it is and will never repaint or change. So there's no reason to really send out any type of alert. Hi, Susan. She's asking, does it work for Forex? Yes, the same rules and techniques apply for Forex. In fact, this is just my personal opinion. I think this works even better on Forex. The reason why I didn't show a lot more Forex slides was because we don't have a lot of Forex people that invest in the Forex in terms of monthly bars. But we do have a lot of Forex members, and they're extremely happy, extremely consistent by using the Pet D on Forex. A lot of our Forex members use it on intraday trading in the Forex, so it does not matter. It works well, very well on the Forex markets, okay? In fact, there's a technique, if I could just mention, in the Pet D course that I believe works better on the Forex than on any market at all, okay? And that's explained in there, okay? Let's see, they're asking what are the platforms that we work on? Okay, good question. Let me read you off a list of the platforms that you can apply the Pet D to, and all of our courses and techniques. You can apply the Pet D to, if you want to write this down, to TradeStation, to Metastock, to NinjaTrader, to MT4. Yes, you can use it with Thinkorswim. But remember, if you use it with Thinkorswim, the way they're set up, they don't allow us to actually have the Pet D on their charts. But they have allowed us to splice their data. So what we do is we take their data and then we simply give you a free NinjaTrader platform. And on the NinjaTrader, you can see what the Pet D is doing. Now, a lot of people actually like the NinjaTrader platform even better because of the way the color bars are. And we do this for free. There's no extra charge. Because you have Thinkorswim, you have to pay more for an extra platform. So you can toggle back and forth while still using the data that works at the same time on both platforms. A lot of people love this scenario. Once again, we have a great tech support department. We set you up with all this. It's all free of charge. Usually takes just a matter of minutes and you're up and running, okay? Just set up an appointment. We do it all for you, okay? Now, those are the main ones. If you have questions about other ones, I know it works on interactive brokers and FXCM, but Sierra charts as well. But contact Pro Trader Strategies. You can email them or call them, and they can give you and they can tell you for sure what are the actual or the best platforms to apply it to. But it works on just about all the major ones. Okay. And remember, if you don't happen to have that, if you have Thinkorswim, we can still use it with a free NinjaTrader platform. So you can just toggle back and forth while you're looking at that. Okay. Lots of great ways to apply it, but remember, once again, if you really are serious about taking your trading back in terms of consistency in 2017, I cannot stress applying the PET-D. I use it every day. I used it this morning trading intraday charts, and I made money this morning intraday trading before this presentation because I went off of the signal off of the PET-D. Okay, it's that easy. You can apply it any market, any time frame. But we showed you how to invest today because if you have an extra $10,000, it doesn't make any difference. You can still apply the PET-D to help you with your long-term investments, okay? So if you're really serious about taking charge and taking your trading and investing back, the PET-D, in my opinion, is your best way to go for 2017, okay? So once again, as we close this presentation, the live link is in the chat box on your far right. You can click that on for more information about this discount and the payment plans. But if you're serious about taking charge of your trading and investing, call Pro Trader Strategies right now. Remember, they handle all the technical support, all the questions about the add-ons and the charting software and the discounts, and they can set you up with a payment plan ASAP so you can be up and running right away, okay? So I strongly suggest that. And in closing, I just want to thank you all so much for attending today. I hope you got something out of this. And I really look forward to all of you becoming members of the PET-D course and most especially becoming students of mine at Specialist Trading. Thank you so much. I'll see you next time. Bye-bye.